we have business activity plunging. I don't see that even with the reopening of the economy. As we're seeing in China, you can reopen the economy, but the demand side is lagging well behind. I mean, the social distancing is going to be with us until we get a vaccine. And that is going to hold back whatever recovery we're going to be seeing after this initial detonation. But I guess you can call me skeptical. It's just more an understanding that, let's call it for what it is. This is not really a stock market that is hinged to the economy. In fact, there's no more correlation between the SPX and the GDP. The Fed has broken that down. This is strictly and purely a liquidity-driven rally that we're seeing right now. And so it's easily understandable. You go back to last October, we're back at the S&P 500, back to where we were last October. Last October, the unemployment was 3.6%. Here we are at 14.7%. At the same level of the stock market is rather unbelievable, because I don't think anybody would have believed that could happen. But again, it is, when they say don't fight the Fed, that is not just a glib refrain. We're actually living it in the moment right now.
And this is, and you see this as the Fed injecting liquidity, I would just say adrenaline, steroids into the marketplace, right?
Well, it's, look, the money supply numbers are surreal. You've got M2 growth north of 20%, M1 north of 30%. We've already taken out the peak levels of money supply growth we had in the 1970s when we were watching Happy Days and playing Trivial Pursuit. It's amazing to me how gold hasn't broken out to new highs, but I'm sure that's going to happen. But there's no question that the monetary large assets, the rapid expansion, the Fed's balance sheet has overtaken the economy and corporate earnings as the major source of correlation with the equity market. So that's really what's happening here. And, when the Fed moved to the high yield market, the questions I kept on asking, especially now that Powell's saying, well, we're going to have more to do. Once you move to a part of the capital structure that resides next to the equity market, people believe that they're going to start to buy equities.
All right, Chris Columbus, let's bring you in. Craig Columbus. Chris Columbus. You are an explorer, Craig. I know that. Let's get your reaction to what David just said, your market thoughts and your economic thoughts in light of what the Fed is doing and what the Fed said in its minutes.
I agree with a lot that he did say, in the sense that two things the Fed can't fix, right? Liquidity can't fix solvency. You can't take good debt and turn it into bad. And the second thing, and it is true all around the world, is how do you refire consumption? Because it's not just in the sense of income replacement, meaning you get the transfer payments to the people that need it, but you have to have confidence in your safety. And the problem I see is the country is so divided even on the threat of the virus itself. So really to have a very sustainable recovery, you need behavior to all fire in the same direction. You need behavior to converge. Now, as far as the market, it's not entirely irrational in the sense, though, that if you think about tech, healthcare, communication services, over 50% of the S&P 500. So those sectors benefit from the transformation in our world. Their business models benefit from telework, digitization, wellness. And so the fact that those are also tech and healthcare, the sectors that have the lowest leverage. They're the two least leverage, so you need cash. And the last thing I would say is, remember as an investor, some of these same themes, these growth themes that may be expensive in the U.S., you can access outside the United States as well.